All right, welcome everyone to the loan officer training series with the mortgage calculator. We'll wait a couple of minutes to get started here. Let us go live on all the different platforms. So give us just a minute. We are streaming this live on YouTube, Facebook, Instagram, and LinkedIn. So give us just a second to go live on all the different platforms and then we will get started. Hope everyone's having a great evening. Give us just a moment and we'll get into it. We did put the chat up on the screen there, so you can drop comments there as you tune in. I see some people are already commenting in the chat before we even put it up. So shout out to everybody tuning in early. Matthew, Desiree, Victoria, Julio, Nicole, Benedict, April. Thank you all for the comments and tuning in early. We'll wait just a minute here to get started, and then we will get into it. Feel free to drop a comment there in the chat as you tune in while we wait to go live on all the different platforms. All right, it looks like we are live, so we are good to go. We'll go ahead and take the chat off the screen and we will get into it. But feel free to keep dropping comments there in the chat. But let's go ahead and get it started here. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. Every Tuesday and Wednesday evening at 7 p.m. Eastern, we do this training for loan officers. Now, today's training is definitely something we're very familiar with, which is 2 to 8 unit mixed use properties. Again, we specialize in non-QM loans here at the Mortgage Calculator, and this is one of them that definitely draws the attention from our investor clients. So I'm going to go ahead and hand it over to Jose, our sales manager, 27 years of experience as a loan officer and a realtor, to go over the 2 to 8 unit mixed use properties. So go ahead and take it away, Jose.
Good evening, everybody. Great to be here with you tonight. And in September, it'll be 28 years. So, 2 to 8 unit mixed use property loans is definitely one of our niches. And hint for those MLOs out there, hardly anybody else handles this niche. So if you do try to specialize in this type of product, you will definitely have a captive audience. Almost every prospective deal that comes through that is looking at this product, once we relate to them the great rates and offerings that we have, the buck stops here and they sign the application. So would you rather be fighting through all of the crowds and racing all the way to the bottom? Or would you want to have very satisfied investors pounding your door down, asking you for assistance because nobody else can help them? I mean, you're out there discussing this with your peers. They're not gonna have usually the foggiest idea of what you're talking about. So that's a beautiful thing when you get that kind of satisfaction when you are originating loans, feeling like a true loan consultant, adding value to the transaction. And it just helps everything fall in line with having a successful and sustainable career as a mortgage loan consultant. So even though the title of tonight's training says 2 to 8 unit mixed use properties, it's really with an emphasis on DSCR, debt service coverage ratio, and an emphasis obviously on the investors, because it really is not any 2 to 8 unit property that you're going to be able to occupy as your primary residence. And there's really very little benefit in trying to do it as a full doc loan, because then you would not be able to take advantage of this great product that we have. You would probably have the same or a higher interest rate if you were able to find the conduit to do this as a full doc loan, because then it's going to be a real odd lot type program. With this option that we have, it's really, I mean, they emphasize this product. They love this product, and they give us some great rates. So let's get right into it, right? Okay, so what are we talking about when we're talking about mixed use 2 to 8 unit properties? Well, it's not 2 to 8 individual folios, right? It's one property folio with multiple units. The units can be attached or they can be detached. Again, I mentioned they're not individual properties. Really important to note with this product that it is a residential and commercial component. Our 5 to 8 unit product is a residential only product, which is an amazing product as well. But in this case, we're talking about our mixed use, which does have to have residential and commercial components. And obviously, since it is DSCR, and as I just mentioned, how this type of product is, it is for investment occupancy only. So this is a DSCR program, but that's great because it does permit a lot of flexibility for the investor with rates lower than what you're going to get full doc for this property type in a lot of other outlets. You do have to be aware of the minimum DSCR, that service coverage ratio. So if loans below $2 million, you have to be able to cover your debt service with the with the rental income by at least 110%. So you got to cover plus 10%. That's what they mean by 1.1. And if the loan is above 2 million, you got to cover 1.2. So you got to cover plus 20%. 1.0 is possible at a higher rate. Uh, Most of what I'm going to be discussing in this presentation is going to be the best case scenario rate options, right? The one that really wows them. Now, it's not the only one we have because we have other options, like I mentioned, they're 1.0 or higher with a higher rate, but the rate's going to be like 2% higher in some cases, 3%, and in some cases, 4% higher, right? So, again, when you show that to your investors, you'll see which way that goes. But here, most of what I'm going to be describing here is going to be for our best case scenario. Keep in mind, obviously, in an appraisal, when they're looking at market rent on a purchase, it's going to be the lower of the current rent that's listed on the appraisal or the market rent that's listed on the appraisal. By current rent, I'm talking about if it's leased, right? If there's a tenant in place. So if you do have a tenant, the appraiser's going to go there. He's going to see the tenant. They're going to ask you for a copy of the lease, or if not, they're going to ask for some type of a tenant estoppel letter to confirm what the rent is, and they're going to use the lower of those figures. Same with a refinance. Note, this is real important on vacant units within your unit makeup. It could be anywhere from a 10 to a 25% reduction in the market rent. Now, for our best case scenario program, the one that I mentioned to you, that's what we're going to be using here mostly for what we're discussing, it's 10% reduction. For the higher rate program, the one I mentioned that is going to be your second option, not your first option, that's the one that hits you with a 25% reduction. So you see now that program is really geared towards higher risk situations. Hence, they hit you harder when there's a vacant unit. They only give you 75% of the rent on the 1007 versus 90%. That sometimes catches people off guard when they're doing their DSCR calculations and they don't realize that reduction. Keep that in mind. And another thing real important, there's a maximum 65 or maximum 35% vacancy rate on a refinance. So if your occupancy is 65% or greater, you're going to be good. Obviously, they're going to adjust on each vacant unit. But if you are less than 65% occupancy on the property, it's not going to happen. You're going to have to tell the borrower. Hopefully, it's a refi and they can get another tenant in there. Because if it's a purchase, it'd be really hard to ask the seller to, hey, can you rent it out to somebody else, please? So you just got to be aware of what the requirements are and plan accordingly. Now, credit requirements, LTV requirements, right? You can go up to 75% LTV on a purchase and on a cash out refinance. But again, that's going to depend on the program. In our best case scenario program, it's only going to go up to 70% on the cash out and 75% on the purchase. Haven't really found any outlets to do it at an 80 for this program. You may be able to find them on the true commercial conduit side, but then it's going to be totally different rates, totally different options. Probably not going to be a 30-year full-term loan if it's going to be 80% LTV on a commercial loan. So here we're talking about this hybrid type product that we do that's residential in nature. And that's a real important point to consider because that's going to also limit the, I guess, what we call the zip code risk. And what do I mean by that? Well, whenever you reach out to a commercial conduit, they ask you for the zip code of the property. They plug that into their system, and it kicks out the demographic information for the area. It's going to tell them population density. It's going to tell them crime rates and a whole bunch of other stuff that you're not allowed to do on the residential-based program, but they're definitely allowed to do it on the commercial-based program, where they may tell you, "I'm sorry, I can't do the loan. I understand your DSCR is 2.2. I understand your borrower's credit score is 800, but that we just can't lend in that area." And that's it. That's all she wrote there for your loan. With this product, you don't have that situation. I mean, they're not going to want to do rural if the appraisal says rural, but other than that, they're going to be good as long as everything else lines up. Credit, you can go as low as a 660. Mind you, 660, you're going to get 65% LTV on a purchase, with the best LTVs and rates being at a 740 plus. There is a trade line requirement, but it's pretty easy because notice you only need 3 trade lines for 12 months with 2 of those trade lines being active. The third one could be a dormant account that's been open, no activity, that's okay. So it's not really strict here so much with the trade lines. Collections over $1,000 need to be paid. So under 1,000, you're good. 1,000 or over, they need to be paid unless it's a medical collection or unless it's disputed. But then when it's disputed, it has other requirements, like any disputed accounts over $250 need to be resolved with a maximum aggregate total of 2,000, which would mean if you have 8 accounts and you bring each that are disputed and you bring each down to 250, your 2,000, you're fine. You can keep them as disputed. And which means, for example, if they have a disputed account for $1,200, rather than take it out of dispute status, maybe the borrower has the resources to pay it down to $250 or less, then you'd be okay. And why is that important? Because if you run your credit simulations, you'll know that sometimes when you undispute the account, it drops the credit score. So see what happens when you do that, and maybe that could be an option if the customer doesn't have the money, if it doesn't bring their score down. But 9 times out of 10, it is going to affect the credit score. Plus, you'd have to do a rescore and all these other things. So a lot of times it's easier if they have the money just to bring the balance down to $250 or less, and you'd be okay. Mortgage rates. This is real interesting too, and I have to explain the second part. It's 1 times 30 within the last 12 months, or 0 times 30 within the last 6 months. What does that mean? That means that if it's within the last 6 months they had a 30-day late, they're out of gas. But if in months 7, 8, 9, 10, 11, 12 they had it, they'd be okay. So that's real important to note that, how that distinction works, which is pretty good, because a lot of the DSCR programs out there will not allow a 1 times 30 in the last 12 months. So it's a very forgiving credit here with all of these requirements. Now let's go into some of the asset requirements. And here, we're talking about reserves and we're talking about gifts mainly. Keep in mind, reserves, if the loan amount is $1 million or less, it's 3 months reserves. And here we're talking about subject property only. 6 months reserves if it's $1,000,001 to $2 million, and 9 months reserves if it's over $2 million. Keep in mind, for each additional property, it's 3 months reserves with a maximum cumulative of 18 months. So that's not so bad. And sometimes that can be an issue when we have borrowers with 8, 9, 10 properties. Just imagine if they hit them with 3 months for each property. That would be crazy. Gifts. Now here, this is very interesting. The best case scenario program here follows Fannie Mae guidelines for gifts. So you can have, well, to an extent, you can have gifts with a minimum of 5% borrower contribution. Now, gifts are never allowed for reserves, but they are allowed for the down payment and the closing costs, with the borrower putting at least 5% of their own money. However, blood relatives only, no close personal friends. Well, blood relative or fiance, I guess they figure if they're going to marry you, they'll let them give you the gift. But in Fannie and Freddie, you can use close personal friend as long as you can document it. Not in this case. They want blood relatives, grandmother, grandfather, mother, father, brother, sister. Not sure if they allow aunts, uncles, and cousins. You'd have to look at the guidelines on that. I can't remember right now. But blood relatives only. No gift of equity allowed. We do get that question every now and then. Retirement accounts are allowed at 60% of their face value. Stocks and bonds and other similar accounts at 100%. And any asset account to be used has to be inside the U.S. So you'd have to bring the money into the U.S. and put it into an account to be able to use it. Now, who are the eligible borrowers that we can have? Well, we can have citizens, permanent residents, non-permanent resident alien. Now, what is a non-permanent resident alien? That is somebody who, and I'm not talking about little green man, is somebody who is legally residing in the U.S., legally working in the U.S., with the proper documentation, work authorization document, and certain visas that are the only acceptable ones for a non-permanent resident alien. All that is clearly spelled out in the guidelines. Wasn't going to bore you with that here. Plus, it would end up with a lot of small print. But just note that for the non-permanent resident aliens, they do have to have the proper documentation and they do have to have the proper visa. Not every visa type is acceptable. Now, really important here, because we do get asked this question, foreign nationals are not eligible. Is what it is. You can't sell them the 2 through 8 unit through this product. There may be other products out there for them, but not this best case scenario product. It's not for them. Foreign nationals are not eligible. Individuals are eligible. You don't have to take title in an LLC, although, we definitely recommend it for purposes of limiting your liability. lawsuits. Imagine if you have it in your personal name and something happens in the property, somebody can sue you, and vice versa. So if in the real world you have an accident with somebody and now they want to sue you and you own this property in your personal name, they're going to attach whatever judgments they get against you personally against everything that you own in your personal name. So why take that chance, right? It's just a little bit extra to set up that LLC, a little bit of accounting work, but it's more than made up by the additional benefits, the tax write-off benefits that you're going to have by having the property in an LLC. Now, the LLC or corporation does have to be U.S. based, cannot be offshore, and you can't have these multiple layers of entities here. So you can't have the LLC own another LLC that owns another LLC. We get these investors that try to get really fancy. Well, unfortunately, that's not possible here. Uh, Very important to note also that each member that has at least 20% or greater ownership of the LLC has to be on the loan as a guarantor. But on the good side, they're going to go with the best credit of the borrowers. They're not going to go with the worst credit of the borrowers. This particular option is really cool in that way. I don't know how they figure that out, but they give you that benefit of if you have multiple borrowers, they're going to use the highest middle score of your borrowers. So don't fret thinking they gotta get, structure their LLC differently because one of the borrowers has a 500 credit score. That's okay. As long as they don't have a lot of liens and judgments against them, that's a different story. Now, IRAs. I mean, every now and then I have somebody ask, can I own it in an IRA? No, not this one. No blind trust, no land trust, and most inter vivos revocable trusts are not permitted. Mainly, you can pretty much figure LLC, S corp, C corp, limited partnership as the ownership entities that are usually going to be acceptable. And very important to note, first time home buyers are allowed, and first time investors are allowed as well. Now, with a first time home buyer, uh, what is really important to note is that they have to have a verifiable housing history for the last 12 months. What does that mean? That means verification of rent from a management company, real important, right? That not from a private owner. That means 12 months canceled checks, or that means being able to show the bank statements for the last 12 months to show the debits for the housing history. If you got that from a borrower who's a first time home buyer, you're okay. Every now and then we get borrowers living rent free that cannot verify any of that information. They're out of gas. The only time you can have a borrower that doesn't have quote unquote a housing payment, which would really be like a loan payment, would be if they own their property free and clear, or a property free and clear, which is usually going to be the one they're living in, and they can show that they're paying the annual taxes on that free and clear property, and that it's not delinquent, and then that could count as their housing payment, right? But so this is really cool because a lot of DSCR programs do not allow first-time investors, and a lot of DSCR programs do not allow first-time investors that are also first-time home buyers. This program does allow that without any LTV reductions. So that I got some property requirements here, which I think is my last slide, but this is really important to note here on the property requirements. The minimum size per unit of all these units is 400 square foot. That's going to be, the residential units, by the way, minimum 400 square foot. Minimum 50% of the square footage must be residential, right? They got to be 2 stories. So you can have detached properties, right, to make up the 8 units all under the same folio, but they got to be 2 stories because the idea there, I would imagine, is that the residential units are on the second floor and the commercial portion is on the first floor. And here's a very important part on the commercial is they really want it to be more like professional offices, retail, stuff like that. They do not want uh, an adult living facility, they like a daycare for older people. They don't want daycare for kids. They don't want a nursing home. They don't definitely don't want anything with manufacturing because you're gonna have contamination. They don't want any type of worship facility. I guess that means no churches or anything similar to that, and they don't want any gambling. They don't want anything of any type of illegal activities or anything like that. No cannabis business. So unfortunately, if it's a dispensary, they don't want it because the state may allow it, but federal doesn't allow
So,
it yet.
so what do they allow, Jose?
Right. Well, anything other than that, right? It's
Which
like
is,
well, like I was mentioning, professional offices
yeah,
and retail are going to be the two most popular kind of offerings. I didn't see them say in the guidelines not allowing a restaurant either. So possibly looks like restaurants would be allowable, which is cool.
probably
Right?
not bar, but maybe like a
Yeah,
cafe or
yeah,
yeah.
exactly. A convenience store, stuff like that would be good. No operating farms, even though if it can't be rural, I don't think you could have an operating farm, but got to put that in there. On the residential units, you do have to have a full kitchen and a bathroom. So full kitchen, that means you got to have a stove, cooktop of some type, with an oven of some type, a sink, and a fridge. Doesn't mean you need to have a dishwasher, incinerator, or any of those other things, but you do need to have the basics on the residential portion. And it has to represent the highest and best use. That doesn't always come into play, but sometimes it does. So be on the lookout. Uh, Again, I mentioned it can't be rural. That means if the appraiser puts that it's rural, that's it. You just got a big X on your deal. Max 20 acres, which if it's 20 acres would probably usually be rural in nature as well. And keep in mind and keep note on the condition. It has to be C4 or better. And for cash out, 12 months seasoning to get market value for cash outs. So pretty cool program. I mean, the mixed use program and the 5 to 8 unit program are probably my two favorite programs to work. Right? Because okay, you're not going to get a million people soliciting you, but everyone that does is almost a sure deal that if you listen to them properly and you put on your consultant hat, you're going to get that deal because there's just not that many people you're going to be competing with. And if they're serious, if they're ready to do the deal now, they're probably going to do the deal for you and they're going to love it and they're going to refer you a bunch of people. They're going to get all excited and they're going to refer you their investment club friends and all that kind of stuff. I mean, it's almost 100% conversion rate on these deals. So that's obviously why I love doing them. And every time we have this show, either on the rates show or here, we get quote requests and we get applications.
All right, looks like we got a couple questions here, Nick, if you want to pull up some of the questions.
Yeah, that's a good question. If they own somewhere free and clear, but multiple people own it, how does that work, Jose? If they're trying to prove their occupancy and housing history?
Okay, yeah, that's a good question, right? That's one that we probably would have to put out there to the scenario desk because the guidelines don't address that.
Mhm.
Because you have individual borrowers, and I'm not sure how they're going to gauge that. But I mean,
So typically, though, if it's a rental property, right? If they are partners in an LLC that owns a rental property, that will satisfy. Have they owned a rental property? Just say yes, right? It doesn't matter
Yeah.
if they own X or Y%. They own a rental property. Now, if they only own 1%, and they start digging through there, that might not be usable. But
Right.
I've never
But
had someone just own 1% and try to say that they've owned it, right? So.
But the other part of this question could be if they're first time home buyers and they co-own the other the property that they're buying. I think like more than one borrower is going to be on that loan, and not every borrower has the suitable housing history. Are we going to be able to use all of the borrowers?
Yeah.
Remember, this is a DSCR loan, so we're not using income here. We're using credit, right? So yeah, that's a gray area question, one that we'll definitely have to research for you.
They're saying about an inherited property, so that makes a lot more sense then, right? A bunch of family members inherited it and own a small percentage. So otherwise, they would be a first-time buyer, but they happen to have inherited a property recently, a portion of a property. That's a very good question. Very good question.
Yeah.
I don't have the answer for that. I'll bring up a new question now. So, next question here from Sonara. What about auto? Auto would be manufacturing. That's a big no. Big no. That's the worst, right?
Absolutely. That's the biggest contaminator there. So they're not going to allow that.
And just in general, right? Just in lending, auto is no good for the most part, right? It's going to be really hard to find homes for auto repair shops as far as a lending conduit.
Yeah, those are tough. Environmental.
Which I'm assuming is because of the environmental issues, right, Jose?
Yes.
Is typically why.
Absolutely.
Yep. And be careful if there ever was an auto repair on a place and you're trying to do something else. The environmental is still just as bad as if you're doing, the auto repair. So it's going to be a problem. Jerry's asking here, wine bar cafe on the bottom, residential on top. We discussed that. It doesn't say explicitly no, but it doesn't say explicitly yes. So I don't think we have the clear answer here, right, Jose?
Right. The issue when you get to those types of businesses is that they tend to go out of business, quickly, and then especially after the pandemic, when they shut them all down, there was a realignment of how commercial conduits viewed restaurants and cafes and bars. So we would really have to reach out on a case-by-case basis if it's any situation like that.
And remember, guys, this is commercial. Like we talk about in the trainings. Remember, there's no rules on commercial as far as the lenders, right? If they just don't want to do something, they can say no, right? This isn't a government loan where they have to offer equal opportunity to everybody. If they think that cafe or wine bar or whatever you're talking about is too niche, they can just say no, and there's nothing we can really do, right? Even though the guidelines didn't say no, they can still say no, right? So Just keep that in mind. This is commercial. There is no quote unquote laws that they have to follow to give everybody equal opportunity. They can just not like something. So that's why we want to make sure we structure everything like Jose is saying. We understand the program, we structure it correctly, present the best foot forward for the client, and lock that deal in for them.
Yep.
Okay, this is a good question here. Last minute question. Could this be used for new construction of a mixed use?
Well, I'm trying to figure out if they're asking a construction loan or just a new property, right? That was newly built and it's mixed use. If it fits the guidelines of what it has to be, yes. As long as you have what you need, commercial and residential component in the manner that you need it, individually folioed and all that kind of stuff, So yeah, there are cases where, You get condos that have residential on the bottom. Commercial on the bottom and residential on the top, as we know. We recently sold one of those, right?
Yeah.
So it could theoretically fit those needs, but not construction.
Yeah, she put another comment in here about land and then building, right? So no, this is not a ground up or a fix and flip. However, we do have some fix and flip that does allow for the 2 to 8 or 5 to 8, 2 to 8 mixed use or the 5 to 8 residential. But that's not what we're talking about today, right? The rates and programs and the pickiness, everything's a totally different ball game. It's hard enough to do a fix and flip. Imagine doing a fix and flip on a mixed use. You're doubling or tripling the complexity there. So just be very careful trying to crack that nut there.
But this could be the end loan, right?
Mhm.
You do the fixed flip or the construction loan, and then this is the product that refinances you out of that loan. If the investor wants to keep the property instead of sell it, then this would be your end loan. Which a lot of times when you are getting one of those construction loans or fixed flip loans on one of these types of properties that's a little bit higher risk type property, they may require you to give your, show your exit strategy. Is it going to be to sell or is it going to be to hold it? And then if it's going to be to hold it, you'd have to show your end loan financing, pre-approval, and all that good stuff.
Good questions today. Thank you, guys.
Yeah, absolutely. All right. Well, Jose, we're going to go into part 2 of this tomorrow. What are we going to talk about on this tomorrow?
Yeah, tomorrow we're going to give just a lot of different scenarios, quotes, pricing, stuff like that, so people can have a little bit better idea. So when they are talking to those investors, they can have, give them their 30-second elevator pitch and know what they're talking about.
One more question shot in, but I think we addressed this earlier. She might have missed it. Amanda is asking, would this allow for a mixed-use group home that has rooms and not units?
Nope, because like we mentioned on the residential portion, the units have to be at least 400 square feet, and each unit needs to have its own kitchen and bath. The boarding type home that you're talking about there, and Amanda, I know the property you're talking about because you and I met about that property, and it's actually a listing that she has. That's a big boarding type home that she's trying to place financing for. No, it wouldn't work for that one, unfortunately.
Yes, they're picky. Any of those niche things they're going to want to get away from, right? Remember, this is kind of that borderline product. They don't want anything that's going to be outside of a real tight scope. But as long as it's residential and not outside that tight scope, this is the best thing going, right? Like Jose said, we're having a very good conversion rate because there's not many other places that have this outlet.
Yeah. So that's a good lead plan to be on. National 5 to 8 unit and 2 to 8 unit lead plans, because those investors don't just have this type of property. Usually they're moving up to this type of property and they have a bunch of other properties that if you give them the good proposal, then they're going to say, okay, Jose, that sounds great. Now, why don't we cash out these other 4 properties so I can have the down payment for this property? And next thing you know, you got a 5-pack out of it. So that's the way I love looking at this.
All right, great. Well, we will go ahead and pick this up, part 2 of this tomorrow. So thank you, Jose. Thank you, Nick. Thank you, everyone, for tuning in. And we will see you tomorrow, Wednesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks, everyone.